Two of the most important financial statements when you're running a business is going to be your income statement, also known as your profit and loss statement, and your statement of financial position, or your balance sheet. Now, they're two very different documents, aren't they, Andrew? What's the purpose of the profit and loss?
Obviously, our profit and loss measures our income, less our expenses, which can give us an idea of how profitability may be going with the running of the business. Our statement of financial position is more taking into account what equity we may have in there. We're identifying how our business stands with its assets against its liabilities, its owner's equity, how much we've put into it, and whether we've got a good, secure business. But I think the best way to describe it would be to do some examples.
I agree. Let's have a look. So, Andrew, here we have the profit and loss statement and the statement of financial position. Now, I think it's really important that we explain, I suppose, the difference between the two, because the profit and loss statement is done over a period of time. So here we've got the 1st of June to the 30th of June, that being 1 full month's worth of income and then 1 full month's worth of expenses. Whereas the statement of financial position, also known as the balance sheet, is done at one particular point in time. What are your total assets, which we'll come to in a second, on one particular time? What are your total liabilities? And then obviously what is the owner's equity, or what the owner has put in through in terms of maybe capital or something along those lines. But let's break each of these sections down. So starting with the profit and loss, I think income, I suppose, speaks to itself.
It's pretty straightforward with income items. Obviously, you're looking at commissions, you're looking at property management, you may be getting some other auction fees or other things. It's pretty straightforward that is cash income that's readily coming into the business.
Come into the business, exactly right. Now that's going to give you a gross profit. Okay, so all of the income is what they call gross. So gross, there's nothing has been taken away from it yet. To get to the net profit, you need to take away the expenses.
We look and say, okay, what are our wages bills, accountant fees, solicitors fees, the running of the business, of your electricity, phone, rent, all those sorts of current expenses that you're going to be coming up with every month. During the running of that month, they're going to all be going into expenses.
Exactly right. And obviously, if the expenses are greater than the income, you're running at a net loss. If your income is greater than your expenses, net profit, which is
pretty straightforward.
Where we all want to be, obviously. All right, now as we move over to the balance sheet, we've got 3 parts to the balance sheet. So assets, liabilities, and owner's equity. Now let's start with the assets, because they're broken up into current assets and non-current assets. Number of different words that can be used not only at this level, but as you go through, I suppose, what is in the middle, because some people call these fixed assets and not fixed assets. But if we stick with this terminology, current assets means what?
Current assets are things like what you've got in the bank, what may be available to the business to be able to use for those sorts of things that can be turned into cash within a short period of time.
Yeah, generally they say sort of within the 12-month period. So anything, if you're looking at assets, anything that's going to be able to use within 12 months, that's going to slot in here at current assets. Non-current assets is the same thing. It is an asset, but it is something that is going to be held a little bit, obviously longer. So 12 months and above.
Exactly. Your premises.
Exactly.
Perhaps you put motor vehicles. Those sorts of things that you're not going to turn into cash immediately, but they are still an asset. They are valuable to the business. They all go towards building your assets.
And this will make a lot more sense as we particularly go through certain items. So stay with us just for a moment, because as we go into liabilities, we're going to have current liabilities. The 12-month threshold or statement, as I suppose the line in the sand you would call it, is going to apply here. But a liability is?
Well, a liability is something that you're going to be paying shortly. In our exercise that we use, we talk about GST payable. Now that may be a liability that is due. It's not an expense because it hasn't been paid yet. It is due to be paid, so that is a current liability.
So non-current liabilities then, Andrew, are obviously going to have that same line in the sand. It's a liability that is greater than 12 months. What are some examples?
Well, you probably look at your bank loans, your finance, those things that are going a little bit beyond that you're not going to pay within the immediate 12-month period that they are going to be there, but they are still a debt that you need to take into account.
Definitely. And owner's equity. So that could be things like retained profits or what they call net profit, which we will come to shortly. Any capital that we've invested in the business, and that would be put in here. So I think it'll make a lot more sense if we run through a couple. So in the trial balance that we have in the assessment, there is in one of the projects, we've got a list of things that we need to figure out where they go.
Okay.
What's at the top of the list, Andrew?
Premises.
Premises. Perfect example. So where would you put that, Andrew?
Well, premises are obviously something you're not going to turn into cash straight away, but they are an asset, a non-current asset or a fixed asset. They would go straight in there. So what we're doing is...
What's the value?
A value on that is $370,000.
$370,000. Perfect. All right, next one on the list
is the bank overdraft.
Bank overdraft. Now that's an interesting one because we know that is, people can consider that, I suppose, an expense because you have to pay it. However, it's not payable just yet. So hence we've got to move it into the liability section.
Current liabilities.
Exactly, because we're looking to pay that generally within 12 months' time. So overdraft, and the figure?
$20,000.
All right, what else do we have?
We've got utilities.
Utilities.
Or running expenses.
So you can name it right there. So it's going to be an expense. So and the figure?
$3,750.
Great. What else?
Sales commissions.
I think that's going to be pretty straightforward. I think we know that's going to be income, isn't it?
Straight into our income, $380,000.
Okay. What else?
Commissions receivable.
Commissions receivable is an interesting one, because we know sales commissions is the income we've actually got in. Anything that's receivable, and like I mentioned, there's a couple of different words that can be used in the accounting sense, but when you hear the word receivable, it means it hasn't been received yet. So it can't go in the profit and loss. We know it's got to be in the statement of financial position.
Straight into our current assets.
Exactly right. Because we are expecting that money,
but it's not paid into our income yet. So that totals $67,500.
So as we said, receivable, we're expecting it, and we're going to be expecting it within 12 months, which is why it's a current asset, not a non-current. Great. What else?
We might look at one called capital.
Capital. Now that's a great one. Like we said, anything that the owner puts in, like capital, sometimes it might be retained earnings, which we'll get to in a second, but that's going to go right in here.
And that capital will be for $100,000.
Okay. Next one.
Let's have a look at bank loan.
Bank loan. So we know, as I said, sometimes we're paying it, but we're not yet. It's going to certainly fall within that liabilities category and greater than 12 months. So we're going to know that is going to be a non-current asset.
Liability.
That liability, you're right. And how much?
$50,000.
So as you go through this project, you will obviously be able to work out which it's going to go into where. You've got basically 1, 2, 3, 4, 5, 6, 7 options here. You need to work out where it's going to go and then how it makes it. But the really important thing to work out as well, particularly in this project, is we've got the profit and loss. So you're going to have a gross profit after all your income's coming in, and you're also going to have a net profit, which is what it's going to come out to. Now, one of the great important things that you look at here is that's then going to be termed as a type of owner's equity. So that is then, this figure is going to slide right into here and could be used as a couple of different words, whether it's retained earnings, net profit, whatever you'd like to use here. But because that, particularly if it's a profit, obviously, that's going to be money left owing. So it'll slide in right into this owner's equity section at that point in time after the end of the month, if that makes sense.
As you explained, the profit and loss up to the 30th of June,
yep.
And then our statement is on the 1st of July. That's where our profit from June 30 is listed in the statement of financial position. And that gives us a good understanding of how our business sits at that point of time.
Exactly right. So hopefully that helps with your project. If you've got any questions, obviously let us know.